So much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of N Jayakumar, MD and Group CEO of Prime Securities, somebody who combines the global and the local, central banks and geopolitics, the macro and the micro with aplomb, and has seen multiple such cycles. And we are on the cusp of some fairly interesting times for the global and the local market. So it's great to have him today. Jake, it's really good having you. Thanks so much for taking the time out.
Well, thank you for the kind words for starters.
No, I meant every word I said, Jakes, because I've observed you through the years, and the observations really help in trying to dissect and separate the wheat from the chaff. Let me just ask you, Jakes, does the current environment worry you? It's a potent combination of a slightly different central banking trajectory as well as some near-term geopolitical tensions.
I think you need to be always worried about markets. I think the day I walk into the market saying, for the next 3 months, I'm comfortable and I don't need to be worried, I think that's the beginning of the end. So I think the reality is there's risk being priced in all the time. It's only a question of figuring out how much risk is being priced in. I think that's the issue really. And when there's easy money, which is sloshing around in the system, as has been the case for the last couple of years, the worry factor tends to be a lot less because the short-term price moves alter thinking far more dramatically than anything else. So what happens is that you're sitting in front of a screen and you can't quite take your eyes off the screen. And if you're seeing a sharply rising market, you tend to forget all the other worries because the recency effect or the top of mind is what you see. So I think from an investor standpoint, you probably need to, at all points in time, take more than a step back to figure out if you see too many noises of bullishness, such as have been the case recently over the last 3-6 months. Clearly, the market's shown that it will top out when you least expect it to. So I think an 18,000, 18,500 is pretty much a top for the moment. And maybe 16.5 is the 10% range. 16.5 to 18.1 could be a good 10% range at this point in time. That is one side. Of course, you'd be worried because we've never seen these factors play out in the way that they are, which is a combination of easy money now very clearly being told that it's going to be pulled back. More importantly, bond yields have started shooting up. In the context of commodities, you've seen commodity inflation probably at the highest you've seen in the last almost decades. This almost confluence of multiple commodities going through the roof, if you will. Now, there is an automatic check and balance in this which is working through, which is that if commodity prices shoot up quite dramatically, I don't see the rising interest rates as being a scenario that will play out. Because you automatically the market is adjusting to inflation on its own. You don't need to raise interest rates or be that hawkish. So will the central bankers then turn out to be less hawkish because prices have gone much further than they anticipated? The fact they were behind the curve in the US is well known. So there are checks and balances that work their way through. But there's an interesting aspect I want to bring to light here, which is that most international markets went up on the back of liquidity that was low-cost debt. So people put out, long, 10-year, 15-year paper. The banks were happy to fund and give you credit for 5, 10, 15 years at low or no interest rates, variable as they might have been at that time. So when the debt is sought to be pulled back or reduced, there will be an impact in terms of markets everywhere in the world. But India has been fortunate that the Indian government did not print. The Indian government did not give the classical fiscal stimulus, if you will. The Reserve Bank of India schemes were more in the nature of the central government giving, guarantees or contingent liability kind of support. So the real money that came into the Indian market has been the startup ecosystem. In the startup ecosystem, nearly $40 billion has walked in over the last 3 years. And that is equity money, money that doesn't have to go back, money that might have been committed to India, but money that's not going back in a hurry. In fact, it will only go back through a massive inflation of asset prices in the secondary market, which results in, as you're seeing, about $15 billion or $18 billion of FII sale that has happened over the last 4 or 5 months. So really speaking, what's come into the market is equity kind of money in the Indian markets. In fact, it's not equity kind, it is equity money in terms of the startup ecosystem, which finds its way into the economy through jobs, through creating demand for consumption, for houses, loans, etc., employment, and that works its way into actually being a salutary, massively salutary stimulus for the markets, but not given by the government, which has resulted in India being one of the best performing markets. And therefore now, when the hot money wants to move to places like China, that money is the ETF withdrawal that you're getting to see. About 1,30,40,000 crores, nearly $18-20 billion over the last 4 or 5 months. If you net that off against some of the monies that might have come in the IPOs, you'll see that about net $15-16 billion has walked out. But 40 billion walked in. And that is the massive, and what's walked in also has taken on the form and shape of SIPs, etc., and larger savings into the Indian markets, as evidenced by, the millennial or the next generation, working their way into the employment ecosystem. So there's been a massive sort of change in the kind of money that's come in. Local liquidity has dramatically gone up as a result of what we just said. It is not contingent on money being pulled out in the rest of the world. The hot money will, as I said, come out, and I think a lot of it has come out. So based on all this, I am of the opinion that 16,500 to 18,100 may well be the range that we'll operate on. The index will get rebalanced when an NSE walks into the index or an LIC walks into the index, and that will reduce the form and shape of some of the others. And clearly, one of the sectors that I think will get hit badly is the valuations in the startup space, which by that I mean, whether it's a well-performing new listing or not so well-performing. The not so well-performing may go down 80%. The well-performing may go down 50%. And I don't want to mention names here, but I'm sure people can draw their own conclusions. And especially startups that have no claim to fame, no business model defined, and certainly not a profitable business model. And there again, there is the paradox. If they have no profitable business model to demonstrate, they will get crushed. And if they have a small profitable one, they have a finite PE, because the moment you announce profits, the PE becomes finite. Until that time, you keep talking about infinite PEs, right? You talk about multiples to revenue, etc. But the markets at the end of the day are slaves to earnings. And the moment they see earnings of a startup that's profitable but makes small amount, it will start trading like so many other businesses trade in the market with that level of profits. So I think we are at a stage where the nasha of the markets in terms of the new listings, the listings on the new age economy stocks will come off, and the markets will move towards the way I see it sectorally, PSU banks, metals, and a lot of the others which have cash flows and earnings but are low on multiples. That's the sort of ecosystem I see, and therefore the index actually being pretty much range bound in this kind of range that I talked about.
Okay.
So long answer to a short question. I apologize for that, but
not at all. Not at all. Lovely to hear this. So gravitation maybe towards a little bit of value. Can I just squeeze in a couple of other things before we get down to some of the knickknacks? Could there be a possibility, James, that there could be, while there is a broad range that you've kind of put out, how high is the probability of oscillating well beyond the bottoms, if you will, considering the fact that even if a war doesn't happen, hopefully doesn't happen, the fear of that rakes up crude prices, and if the Fed minutes and some of the other outspoken Fed governors speak about maybe intermeeting hikes or more rate hikes, could that disrupt the sentiment too much or damage the sentiment too much to cause further downsides in the near term in the first quarter? There is, of course, also local factors like the UP elections, which might also be a bearing.
Well, sure. I mean, if markets were orderly, we'd all be very happy, right? So because they will be disorderly in the short run, with factors that we have not gleaned or factors that we are not smart enough to have presaged. So you will need that surprise element. I think a war in Ukraine, my own personal feeling will be, if anything, very, very short-lived. It may be more a show of strength, more a show of the fact that, please understand who's boss, rather than, a protracted land grabbing exercise. I think pretty much, we have run our course, at least in this day and age, of any extended wars. That's the way. I think there's too much pressure on people to avoid casualties in a full-blown war. So I think you'll need a factor which we don't know. If I can logically put out a factor that nobody here has played out, then then obviously I'm a genius. But the way I see it, that's not the case. So if I'm only able to talk about factors that are all known, and I think known factors won't take the indices beyond these ranges, is what I believe. But they will always be in the market an unknown element, which is the joy of the markets themselves.
That's true. Okay, fair call. So okay, thank you for that. The other factor, Jakes, is how do you see the internals in that? You very rightly pointed out that the flows, at least on the internal side, are strong, and they've kind of countered the quantum of outflows on the global side that we've seen. With the presumption that remains strong, do you reckon that after a bit of a margin debacle of sorts in Q3 for India Inc., if indeed commodity price pressures abate a little bit and we get some bit of a pricing, some bit of economic uptake, government support, etc., could this be the balm that Indian equity markets need to inch up higher toward the higher end of the range?
The higher end of the range will come from earning surprises. I think you'll need very, very strong outperformance on numbers for earnings to be then telling us that the market is discounting us poorly compared to the implicit growth rate that companies are able to see. Companies have indicated that during the pandemic, they managed costs well. They managed a lot of the supply chain issues well, and came out with numbers that actually beat everybody's expectations. So India Inc., in a sense, went back to the age-old, if I may say, and I put it as a housewife trait, if you will, of saving. So they basically went and saved wherever they could, cut off wasteful expenditure wherever they could, and came out with numbers that were far better. But now going forward, you need a revenue push. And it is not just cost savings that will add to profitability. So if the demand offtake or the capex cycle or actual consumption just took off where revenues were far higher than what people expected, that could take you above the range. Otherwise, it will be difficult to have a sustainable move above 18.1, 18.2 on the Nifty for any length of time, at least over the course of the next 1 year. And then, of course, at the end of the year, you're discounting 24 earnings and not 23. And maybe there will be, offshoots. But were there to be a very orderly world, I would think this would be the sort of way. But the composition of what outperforms in this period is another story altogether. And I feel there's a possibility that the likes of the PSU banks, where the NPA cycle is behind, the move to digitization, the move to granularization, the move to SME, the move to retail loans, etc., start mirroring, I would say, private sector kind of behavior, but the valuations have been massively hit. So if the number one private sector trades at 4.5 times book, why should the best-in-class top 2, 3, 4 banks in the PSU space not trade at, for instance, 2 times book? Okay. And even that would mean a doubling of stock prices from these levels over the next 1 year.
So is the broader theme that unless there is a big negative surprise, equity markets for the interest rate argument or geopolitics or otherwise, or even oil at a higher level, does not really buckle down too much, and a bit of a return to value? I would want to examine your PSU argument, but is there embedded in that PSU bank's argument and metals argument a return to value over return to growth at any price for 2022?
No question. I think growth is priced insanely. I think growth is priced ludicrously. I think you need to view this in the context of value is mispriced in the context of growth, and the difference has never been wider than what it is today. Therefore, I believe a move to value and a reversion to the mean difference between the two. I'm not saying that value parameters will cross growth parameters. No. I feel growth will be to an extent ignored or avoided as opposed to the value argument. And there are a number of stocks that actually fit the bill there. So if some of the top metal stocks are going at a 3.5, 4 EV EBITDA multiple, and as they move towards becoming lesser and lesser indebted, and to some extent, some even become zero debt, why can't these multiples move to 6 to 8? And why can't growth, which is priced sometimes in the triple-digit price earning multiples, move back to the 70, 80s or 50s for that matter? It's a directional call where I think value will trump growth in the short run.
Got it. Okay. Jake, so what happens therefore? I mean, so you made this comparison of relativity comparison between PSUs and privates, even privates for that matter, the last 12 to 18 months per se really haven't gone anywhere, and which has prompted so many people to come out with notes that back up the truck and load financials, so have you. What happens to the other end, which is, like you said, the well-priced new age IPOs, spec chem, IT for that matter, wherein valuations have gone really high? Do you reckon some bit of coming down to earth would happen, or in that also companies which are showing the promise of earnings growth might continue stay at elevated valuation levels?
I think areas like specialty chemicals, etc., had a combination of volume and price in their favor. It's possible that China, while it's very cognizant, at least in terms of evocative statements about their need to keep a clean environment, etc., has actually started moving towards greener sources of, for instance, metals or chemicals. Now, that might not happen in a year, might not happen in 2 years, but as production in some of the areas starts meeting these norms, and the Chinese supply, which has been largely absent, comes back, I think you will see valuations come down on the specialty chemical side, because to my mind, that's very, very clear. Because the pricing part of the price and volume thing, because China went away, volume surged. Because China went away, the pricing power was, as should I say, overwhelming as it's ever been. If one of the two legs come down, valuations will come up. That's as far as this is concerned. Even in terms of metals, etc., I think China has clearly shown that they're not going to go gangbusters in terms of production levels. And therefore, from their perspective, a little more responsibility towards the environment will mean that supply will be there, but a lot less than before. And therefore, I think the efficient metal producers, those whose balance sheets have dramatically improved over this period of time, will do much better than they have done so far.
Okay. Just before I ask my follow-up on IT, one quick question. In the event that, and how much do you, you must have read, and you must be reading a lot of it, but in the event that China abandons its sharp focus on environment in the run-up to the November big political event out there, could there be an upheaval in the way it approaches even commodity production for that matter? And could that disrupt for the near term the bullish argument they're making on metals?
So while it's true that most governments worldwide are working towards lower prices, especially on energy, lower prices, especially on metals, etc., whether something will be achieved in the short run, I'm not sure. Okay. I don't see China doing a U-turn and then coming back later, again moving back. I think China has moved on to a path which may have been overstated in the short run. But clearly there will be some supply easing, especially post the Winter Olympics, supply easing, and you don't have to wait too long. It's a week away from closure. So you probably get to know even as early as next week, week after. But it's not that they switch on things a week from today. Mm-hmm. They've already moved towards getting production levels going, etc. So the fact that China will re-enter global markets, maybe not as an exporter, but with maybe not as an exporter of size, but with some exports, could put a lid on some of this. The demand for oil, I don't see it disappearing. I think oil has been a supply side story. and that needs to change. There have been too many pockets of geopolitical issues which need to play out. There are talks with Iran going on, which could change, etc. Change the supply dynamics. So I think individual pockets will be there, but again, in metals, a lot of people sort of favor the clean metal aluminum as opposed to steel, for instance. So those kind of plays may happen. But I think largely we are still in the midst of a commodities boom, a boom that has been exacerbated by supply side shocks.
Right.
But as the supply side eases off, or hopefully eases off, we will have a situation where metal prices will have stabilized higher with much better margins for the metal guys, because they've also been working towards improving iron ore, coal, and other sourcing. So given that kind of stuff, I think you'll have metal prices stabilizing higher, much higher than earlier. So for instance, if the Asia and the European side, let's say, was ranged between, for argument's sake, $450, $500 on the low to $900, $950, I think there's a good case to say that we probably now are at $750, $800 on the lows to $1,150, $1,200.
Wow.
So metal prices have moved up because structurally sourcing of commodities as inputs has moved up. So there are these disruptions that have taken place. So I think obviously technology has made this a far more happily volatile world, because so many things are changing at the same time. That it's difficult to make a prediction beyond a couple of quarters. But for the immediate 2 quarters, this is the way I see things happen.
Okay. Jex, I know I've overstayed my time, but 2 or 3 more quick questions. We can do a rapid fire if you will.
Sure.
Are you as sanguine about oil upstream or no?
Not really.
Not really. Okay. What about information technology? Promise of earnings growth, yes, but valuations have moved up. Though in the recent past they have come off. What's your thought here?
I think every dip is a buy there. I think it's a much, much larger generational change of technology adoption and new technology, and Indian companies happily are moving up the value chain as well. So I would say that large dips or any exacerbated coming off of prices is a good buying opportunity in general.
So not the current 15-20%. You believe if there is a further dip from where we are right now, it could be
the way I see this is the technology will remain expensive. It's not going to come off into the kind of valuation metrics that we've been comfortable with in the past. But I think they will be able to deliver growth. They'll be able to deliver new customers. And technology itself as a concept is changing, right? It never included AI, ML. It never included protein folding, for instance. It's now moving into other areas and other aspects of science and scientific applications. So I think it's difficult to say what technology is, but it's, I think, combining so many things now that in the spaces these guys are in, are they able to value add, the lakhs of people that they hire? Can they be upstreamed in skill sets is the question. And I think the answer is there's a good chance they could. And I think Indians have shown that they will deliver on that. And if that is the case, I think the structural story doesn't change.
Final question, Jakes. The last time that we spoke, you gave us a really good insight on real estate and how the nature of demand of real estate would have changed in the pandemic era. Are there any lasting changes? Are there some newer observations that you have on that space before we wrap up?
Well, I think a number of people believe that productivity has never been higher by working out of home, for instance. So different ways of work will now coexist. Will that create different challenges in terms of office space versus residential? Answer is yes. We're already seeing that. So I think the additional demand for real estate is coming through a number of things. Nuclear families, more people wanting to work and stay indoors, people choosing fitness indoors, etc., ordering indoors. So lots of things are changing. I don't know if these are lasting changes, but some of us who feel that you've got a much longer, busier, more productive day by not having to travel, Nariman Point to BKC and back twice a day, I think are happy doing this out of home. And I think if this continues any further, pandemic or otherwise, other than the novelty of meeting people one-on-one and having that face-to-face interaction, there is really no great. I mean, this virtue of saying, leave home at 6:37 in the morning to come back at 8 o'clock in the night, to have long, hard hours, which includes travel by public transport, etc., may have been an overstated virtue if you can avoid it.
Awesome. Lovely having you today. Thank you so much for taking the time out. And for the next time, I look forward to have you slightly earlier than the gap that we had for this one.
Absolutely. Thank you so much. And good luck to everyone who's watching the show and everything else. Thank you.
Thanks, Jakes. And viewers, thanks for tuning in.
Thank you.